So I think the key thing when thinking about the strategy for risk management is first to base it on your business. What do your investors expect? What do senior management expect? And what are the things that are absolutely basic that you need to be factoring in anyway? There's consensus about how you manage cash. Coming up with a strategy around making sure that you have hold of it and you can use it as liquidly as possible, subject to sensible economic constraints, that doesn't take too much thinking about. So really the areas that you can really add value are sort of around foreign exchange, interest rate management, and a bit around capital management, where there is a bit of a difference between how different businesses respond to different pushes and pulls. So I think there are a number. So the first one is, what are your investors going to think? So we've had transactions that we've looked at that we've thought, actually this makes perfect sense, but with quarterly reporting, and it's just on the edges of, is that something that an investor would expect? They're investing in a pest control company. If something went wrong with this in terms of the way it was reported, would that reflect on us well or badly? And so, from time to time, you walk away from a transaction because you think, actually, that doesn't fit with the risk profile. Whereas, if you're in a more aggressive environment, if you're working for, say, private equity, you might take on some of those risks where, the economics are pretty solid, but there might be some reporting risks around them. And they would be a little bit more immune to those reporting risks. The other thing is around, your employees and your customers. How would they respond? Because again, one of the things that you're doing is you are the guardian of cash for the organisation. You've got people who are working really hard to generate that cash. And so actually, the kind of biblical burying it in the ground to keep it safe and earning no return on it, that's not going to help anyone. But at the same time, losing it, that's also not going to be popular. So you need to make sure that you balance things. So I guess the kind of key strategic factors are around liquidity management. How do we make sure we've got enough cash to fund our businesses? And we operate in 60 territories, so I need to make sure that I've got fungible cash that sits in different places. I've got pieces around, what's the right debt equity mix? So what are investors thinking? What's senior management's viewpoint? So coming up, I've got a session where with senior management, we're going to think about where are we looking to make acquisitions? Where do we want to grow? So that we have a strategy, because you want your strategy to evolve over time. You don't want to be making a big strategic change in one go. We've got 800 million roughly of debt, 800 million pounds of debt. If you decide to move 25% of your debt to a different currency in one go, that's a year's worth of earnings. And if you do that at a time where the FX rate is good or bad, that can be a very material impact. So you need to make sure that you gradually evolve, and so you need to be in tune with the direction that the business is moving. So I think there are a number of pieces. The first one is the sort of operational piece. So for example, today with Basel III coming in, if we're setting up a new cash structure for one of our subsidiaries, I wouldn't go for a cash concentration or cash pooling structure, knowing that really that's under threat. I'd rather go with a sweeping structure or something along those lines, rather than put resources into something that might need to change. I think a lot about the direction of travel in terms of how do we retain operational flexibility, and what can we do in order to leverage our position so that we can give ourselves maximum flexibility. So can I have a situation where I get a slightly lower return on a deposit, but I can deposit for a year, knowing that I have a clause in my contract that says in the event of an acquisition I can break it, for example. So I think a lot about that kind of thing. And in terms of the kind of big ticket, the FX, the interest rate risk, the bonds piece, there are some funny accounting rules in particular that we need to be aware of. You have situations where your earnings can, you can have an economic hedge where you have a debt of 300 million euros and earnings of 100 million euros, but your earnings are going to be translated at the average rate, and maybe the average rate has improved by 5%, but you might find that actually your debt, which is reported at the spot rate in the same period might have actually moved 10% in the other direction, because one is looking at the average rate, let's say the average rate for 2013 versus the average rate for 2014, whereas the other is looking at the rate on the 31st of December 13 versus the 31st of December 14. And so you can really end up with quite big mismatches. And so it's important to understand that, be aware that what you have is an economic hedge, but if you're going to, you need to be aware that there may be a communication issue in that the accountants will force you to disclose this number. And so one of the things that we do is we also disclose what the impact is at an average rate, so that people can see what the impact is and see 5% and 5% rather than 5% one way and 10% in the other direction.